What's the biggest risk that markets aren't pricing in yet? Is it that we keep extending these tariffs and we think that we'll get a deal and then maybe we don't get one?
You know, I think that even if we get a deal around the tariffs, the bigger issue when we think about U.S. China relations is not, what will happen in 2019, but what's going to happen over the next couple years. The global technology sector is decoupling. There's going to be a U.S. standard and a Chinese standard, and that has implications for everyone's supply chains and of everyone's systems, and I think is going to really lead to a more ongoing and perhaps fraught relationship between U.S. and China. That's something that we're a little bit worried about, that we may get this sort of additional relief rally as talks continue, but that the bigger issues are still further out on the horizon. So we're watching Chinese companies invest very, very aggressively on technology and different systems and standards and protocols than their U.S. counterparts. We think if you're going to invest in global technology stocks, you have to own both U.S. and Chinese companies because they are operating on very different systems.
You're traveling to China again for probably the quadrillionth time this year as China becomes an increasing focus for all of us. What do you make, though, of the Chinese economy? Because there were some signs, of course, that the tariffs were hurting them. But I'm reading some notes that China's economy has started to bottom out. We're starting to see maybe some signs of improvement. Do you see that happening? And then how does that fold into equities?
Yeah, we've been pretty constructive on bottoming out in terms of Chinese growth, or at least a slowdown, decelerating. The second derivative we're always very focused on the economic growth side. But we're seeing all of these small policy measures actually start to take root, and we're going to be watching consumption activity very closely in the second quarter. I think the household spending and household activity was even more important than what was happening on the industrial side at the end of last year. And the tax cuts in China, let's see if that ends up leading to a better multiplier on growth, but also some of the new deals that are in place, new policy changes around white goods like appliances and autos, and making purchases a little bit more attractive for the average consumer in China. If that leads to better activity and then leads to better sentiment, that in itself could have a multiplier effect for the Chinese economy. So we're quite optimistic that the second quarter is going to look better than the first quarter and that the worst is behind us in terms of a growth slowdown.
Kate, I keep on hearing actually that investors, money managers around the world are much more worried about the slowdown in China than the trade concerns. How should we look at the Chinese slowdown? Is PBOC managing this in the correct way?
It feels like the policymakers in China are very on top of the growth slowdown. I mean, I think if you had asked our investors on the ground at the end of last year, what sense of urgency did the Chinese policymakers have about growth, they would have given it sort of like, a 5 or a 6 out of 10. And by the time we got to the beginning of 2019, they would have, rated it more like 8 or 9 out of 10. I think that's really important. There has been an escalation in concern and focus on targeted policies on both the monetary and fiscal side that are going to lead to a better growth outcome. And we need, from a global perspective and for risk asset investors, the Chinese economy to be in good shape and for confidence to return in activity. So since that's starting to happen, and as we're getting a little bit of progress on the trade talks, even as I was saying to Taylor, that we have a much longer relationship battle on the technology front that will last far beyond 2019, I think that restores confidence, and I think it'll allow the markets to grind a little bit higher.